The Nigerian government is taking bold steps to overhaul the tax system, with 4 new bills currently under consideration by the National Assembly. These bills aim to simplify the tax landscape, reduce the burden on small businesses, and streamline how taxes are collected. On paper, it sounds like a game changer, a feature where paying taxes is straightforward and the system works better for everyone. But is it all promising as it seems? While some Nigerians are optimistic about the changes, others are questioning, maybe this is the right time, living cost and all of that. Well, let's break down the proposed bills and what it means for us as Nigerians. And here's a closer look at the 4 bills and how they intend to reshape the Nigerian tax system. Now, the Nigerian Tax Bill 2024, the Nigerian Tax Administration Bill, the Nigerian Revenue Service Establishment Bill, the Joint Revenue Board Establishment Bill. Each of these bills is designed to make Nigeria's tax system easier to understand and more effective. Well, let's talk about this. Mr. Albert Folorunsho is a managing consultant of Kreston Pedabo. He's a fellow of the Institute of Chartered Accountants of Nigeria with over 29 years of professional experience in taxation, insolvency practice, and management consulting. He's a fellow of the Chartered Institute of Taxation of Nigeria, associate member of the Chartered Institute of Bankers of Nigeria, and a member of the Business Recovery and Insolvency Practitioners Association of Nigeria. He's a member of both the Working Group of AIDS Implementation in Nigeria, Tax Advisory Committee to the Tax Appeal Tribunal. Thank you so much, Mr. Albert, for coming into the studio. It's good to have you in.
Thank you so much, Tolu, for having me.
Yes, I want Nigerians to know that they are getting from the right source. That's why I had to do that introduction that way. Okay. Well, it's great to have you in. Let's start with your own position on these tax bills. There's been a lot of back and forth. We are not being political here. We're just hitting the issues. What really is your position with regards to these bills? Can you highlight some positives for us?
Okay, so you know that before now we have had finance acts, making amendment to several tax laws. And if you look at our tax laws up till now, so many of them are archaic. They've been there for years. And so there was a need, and there is a need for a proper reform. The tax policy, has been restructured and made clear to the public. And therefore, you have to have a tax law that aligns and work with the tax policy that is in place. And therefore, that was the need for all of these taxes for a general review and bifurcation of all the provision of the law into different buckets. And that's why we have the 4 buckets, the Tax Administration Bill, which is purely about administration of tax in Nigeria. We have the Nigerian Revenue Service to emphasize the fact that the Federal Revenue Service is not mainly for the federal government, but for the federation. And then we have the Joint Tax Bill, which is for the policy management, coordination of taxes and tax authorities, and which also introduced of course, the already existing Tax Appeal Tribunal, as well as the introduction of the tax ombuds that will be a source of mediation between the taxpayer and the tax authority for certain cases before going to court. And then we have the main bill, which is the Nigerian Tax Bill that covers, tends to synchronize all our taxes into one section, particularly the personal income tax, the company income tax, the capital gains tax, the value-added tax, the excise duty. All of the taxes are now together, and then you can relate them to one another. So, and of course, the most critical, which we can point to, is the fact that the bills tend to focus on giving relief to the less privileged and ensuring that those who are able to pay tax are able to pay and ensure that they pay. Okay, so which means we expect more revenue generation while giving relief to those who truly should not be paying tax. And that is the summary, and that is what the bill is trying to ensure. And for you to be able to achieve that, there has to be give and take here and there. There are some nuisance taxes all over the place that has to be dropped, so that we can focus on the high net worth individuals that are able to pay the tax, and then for this revenue to also be directed to the specific authorities, I mean the state and the local government, as well as the federal. And of course, that also brought about the need for the VAT review and the issue around derivation, which I will speak to as we go along.
Yes, it's because that seems to be the bone of contention, the VAT collection and I think sharing issues. What I want to make us understand what used to be and where this bill is taking us to.
All right, so there is a VAT pool where all VAT collected are supposed to be kept. And of course, that will be net of the cost of collection by the Federal Revenue Service of 4% and 2% for custom and excise for those imports. Then the net is in the pool. Now, how do you distribute the amount left in the pool? 50% for state, 35% for for local government, and then 50% for the federal government. That is the amount in the pool. But the question is the amounts payable to the state and federal, the state and local government. How is it distributed among them? Okay, I'm talking about the old provision now. The old provision says that 20% will be by derivation,
okay,
50% by equality, and 30% by population. That was the old provision. So which means by the time you take the total amount that is available for distribution, okay, in the pool, particularly for those local governments and states, that is how only 20% of that is distributed on the basis of derivation. And of course, when you say derivation, you know, the concept did not follow the attribution process where you attribute the VAT to where the VAT was generated by means of value addition. VAT is value added, okay? Which means it is only where value has been added. It is only tax on the value that has been added. For example, if you import, you pay VAT at the point of entry. Then this material is now used maybe in Lagos to manufacture. So much activity will have taken place.
Yes.
And of course, on the basis of that, they will add margin to it and then sell it to whoever is buying, whether the person is taking it to a final consumer or taking it to another state.
Okay.
But you will now look at how much value has been added for Lagos. Then, assuming it is taken to River State, for example, the person taking it to River State will have added value by ensuring that he has facility to warehouse it in Port Harcourt, and therefore that will be his own element of value addition. So the difference between the VAT the Port Harcourt person will charge and the VAT charged by Lagos will be attributed to Port Harcourt, and it devolves in successive stages like that until the final consumer, where the VAT will now rest where the product is consumed. So the provision which has been included in this bill is to ensure that VAT is now distributed on the basis of attribution, where value has been added, and not where it has been collected. That used to be the current provision. We saw analysis of how much VAT was collected for a particular period of about 400 million. More than almost half of that was going to Lagos because most of the head office where these VAT returns are filed are in Lagos. And the essence of this bill is to ensure that it is not based on collection, but on consumption. And when you talk about consumption, we are referring to the value addition, because we also need to correct that so that somebody will not say, okay, so if the product is consumed in Jigawa State, then the whole of the VAT should be for Jigawa. It has taken through phases before it gets to Jigawa State, production, transportation, and all that. So that is what we have. And it is expected that this will give more value to states that have anything to do with the product. Even with this bill, even if the good is imported, we need to ascertain who is the importer. Not all goods that pass through Lagos are imported by Lagosians. If the importer is based in Benue State, it means that the VAT paid at the point of entry will be attributed to Benue State, because the goods are going to get out of the port, go to Benue State for utilization. Maybe they are going to be used there to manufacture. All right? At that point, when they manufacture in Benue State and then charge VAT when they are selling, the VAT they pay at the point of entry will be deducted. So if the product is now sold to Kano, for example, the VAT that will be attributed to Kano will be the VAT charged by Benue State, from which they have already deducted what they paid at the point of entry, which relates to Benue State, will now be compared to how much VAT was charged by the buyer in Kano, less what has been paid, on the items when the goods were imported. The difference is what is attributable to Kano State. And the provision of the bill we have provisions in the law that specify how returns will now be made under the new bill. There's even penalty where you fail to make attribution. Attribution means stating exactly where the product or goods or service has been consumed. Okay, there are provisions, and it says that you must make attribution, which means if it is being done electronically, as fiscalization is also contained in the bill now, which means online real-time transaction. As you are making this, you are issuing the invoice, the revenue authority is getting, alert as to how much VAT has been paid on that particular transaction. So there is also a provision and penalty for failure to make attribution. And section 22, subsection 12 and 11 of the admin tax says that you must provide evidence of where the goods has been, where the items has been consumed, by ensuring that you have a list to support whatever return you are filing. Even if the head office remains in Lagos, the returns must have a list. If it has not, before we get to the level of fiscalization, because a lot of equipment will still be required for proper attribution, for proper fiscalization. But even without that, all banks are supposed now to file returns on the basis of their branches. If there are companies that have branches all over they must include a list to show how much is attributable to a particular place. So that is the intention. And at the end of the day, there is no way we can have a reform that will be worse than what we have now, where Lagos is taking close to 40% and another state is taking another 20%. By the time you put 4 states together, 72% of the VAT pool is gone. So you cannot have it worse than that. So definitely this reform is supposed to correct that anomaly. Yes.
All right, let's move on now. I think there are some things Nigerians need to know more about this document, because for me, during my research, I see that it's going to adjust some existing primary and subsidiary legislation, of course, to give efforts to new ones. So tell us what more you want Nigerians to know specifically, again, about this document.
All right, like I said, the main bill is the Nigerian tax bill.
Yes, that's it.
Which covers both all of the taxing legislation, the personal income tax, the company income tax, the capital gains tax, the value-added tax, and all that. So still talking about value-added tax, a number of items have now been zero-rated. When you say zero-rated, means that you are able to claim refund for whatever cost you have incurred or VAT you have paid in the course of the transaction, while the VAT payable by you is zero. So which means you have a zero output and so much as input. So that input is now payable to you. And the essence is that for products that are really zero-rated, like yam or those food that are now zero-rated, so that the increase in VAT that is expected will not have impact, the essence is to be able to make nominal attribution. That will be done within the system when the fiscalization is complete and proper technology is deployed. It will attribute VAT for those for those zero-rated items, and that is very important. So that states that are contributing on the basis of items that have been zero-rated will not be shortchanged. That has been taken care of in the bill. And again, as a company that is into manufacturing, you are now eligible to claim input VAT on the equipment you have acquired to manufacture those products, including your overhead expenses. And so even if we have an increase in VAT rate from 7.5% now to 10%, clearly government is likely to be out of pocket. But for the purpose of the reform, they have accepted to say, let's start with 10% so that people will understand what VAT really is, unlike what looks like a sales tax that was being practiced or that we are still practicing. Okay, so at that level, at the level of 2025, where we are probably going to be using 10%, and then you are now going to take a deduction for all your inputs or all your input VAT paid on your fixed assets that you are using for manufacturing and your overhead expenses that were not allowed before now. Definitely, the amount going to federal government is definitely, going to the VAT pool account will definitely reduce. But companies are going to make more profits. And that is what people have not been saying. Even though people have been looking at the headline increase from 10% to probably 12.5%. 12.5%, maybe at that point, government will be, the collection may be breaking even. But until 2030, when probably it gets to 15%, that we can start talking about maybe a more significant collection from VAT. That is one. Then if you look at the personal income tax, the way it has been structured now, the low-income earners are going to be paying lower tax. If your income is not more than 12 million a year, you are definitely going to pay less than what you were paying before. But if your income is above 12 million, you are going to pay marginal more than what you are paying now. And the essence is to ensure that the high net worth persons are the people paying the taxes. In other countries, personal income tax generates so much income, more than even the total revenue Nigeria is generating. So if we can focus on those high net worth, and they are ready, of course, they can afford. It's not about ready. They can afford to pay those extra, which will be additional revenue to government. Yes, that is another plus that we can see. But of course, the low-income earners are definitely going to be paying lower, starting from the minimum wage earners, which are going to be at 0% up to 800, and then from there you move to 15%, 18%, 23%, and 25%. That is as far as personal income tax is concerned, and several other provisions in the bill.
I think a lot of education is also necessary here, because Nigerians need to understand all of this clearly. But I know a lot is going on. The committee has been doing a lot, and even educate the lawmakers and everyone to understand, carry everyone along. What's your outlook if this is properly implemented? What is your outlook? We always talk about tax to GDP ratio, how we can increase funds, get more revenue from taxation. What is your expected outlook if this is properly implemented?
So, if the bills as proposed, again, we all have to remember that it is the prerogative of the National Assembly to pass this bill. Of course. The President has sent the bill. They have the prerogative to pass and even to make adjustment as they feel Nigeria requires. So at the end of the day, whatever it is passed, taking away even the contentious issue of VAT derivation, which for me, they can decide to reduce the rate if that is going to be a clog in the passage of, because there are several other things that are more important. If 60% is too high, they want to reduce to 40 or to 30%. It's just a small portion of the VAT element that is distributed on the basis of derivation. And as they are reducing it from 60 to maybe 40, the others are increasing. Equality distribution and the distribution by population. If that is the issue, they can amend that and let this bill go through. There are so many things in this bill. Particularly, we expect that there will be more revenue from VAT, more revenue from personal income tax. The states have also are ready for this because of the nuisance taxes that are not really generating revenue to them, which they have focused and devoted so much time that are not all the road taxes, the wheelbarrow taxes that are taken cover all over the place. We have said, see, you need to jettison all of that, including even Lagos State being ready to jettison the hotel occupancy and all of that and focus on what is coming from this. I think they need to be commended for agreeing for this bill to go through from what I can see. And so we expect that with this synchronization of all the taxes and people, marginal increase here and there, with exchange rate here and there, there's so much that is supposed to come in, and we expect that the tax to GDP ratio will go beyond even the expectation. Go to double figure without any stress. If the law is implemented the way it is.
Like you said, the National Assembly has the final order. We're waiting and we are watching how things play out, and we'll keep following all of these things. I've been speaking to Mr. Albert Folorunsho, making us understand all that has to do with this bill, managing consultant Kreston Pedabo. Yes. Thank you so much. So, concluding, final thoughts from you?
Yes, for me, like I said, the bill is something that we need to embrace as Nigerians. Okay. If you do analysis individually, you will see that the benefit outweighs whatever shortcoming. In fact, derivation is distribution of what has been generated. Okay. So, and the focus of the bill is generation. So if at the end of the day there is a way that the National Assembly feel that this should be distributed should not be a major concern. It's just that some states have agreed, all of the nuisance taxes that they have, they have perfected the way of collecting. They are ready to drop it. And if they are ready to drop that, it means that they are ready for this bill to go through. And they assume that whatever they're going to get from this, if there's any shortfall, even the 55% that was being suggested for state, the committee has said that the 5% can be left hanging so that it can be used to shock any state that is having any shortfall. And I think that you can't have it better than that. So I'm sure with the process that's going on in the National Assembly, without much ado, I'm sure the bill will be passed and Nigeria will be better for it.
Thank you so much. Again, Mr. Albert Folorunsho, who is the managing consultant at Kreston Pedabo. Do enjoy the rest of your day.
Thank you.